In Chapter 10, we will look at different types of residential mortgage and the borrower's decisions among different options for mortgage types. So the overview of this chapter, we will learn about what is primary mortgage market and what is secondary mortgage market. What is private mortgage insurance and how does it help to protect lenders? What are different mortgage types residential borrower could choose among different loans? And if we do have different loan options, which one is a better decision? So the primary mortgage market is what probably everyone is so familiar with. It's where the homeowners borrow money from the bank to finance the purchase of their home. Secondary mortgage market is the pink part in this picture. It's where the banks sell a proof mortgage from homeowners to the investors in the mortgage-backed securities. So what happens in the secondary mortgage market is how mortgage-backed securities are created. For example, in this picture, we have a home buyer John who buys houses, and the bank lent John $150,000 for the loan amount. John has the responsibility to pay the bank mortgage payment every month. And the banks have a large pool of borrowers similar as John. And what the bank did is the banks pull all the mortgages together and sell this bundle of mortgages to very large banks. Those large banks create an investment security called mortgage-backed securities, and they further sell these mortgage-backed securities to the general investor in the market. So what happens is the small banks, they were able to utilize this mortgage and sell it to the big banks to receive some cash flow. And big banks can sell this security to the general public and receive money, so we have much more cash flow flowing into the financial system, enable the financial system to lend more money to the borrowers for the home purchase. So primary mortgage market is where the mortgages are originated or where the banks lend money to the homeowners for home purchase. The lenders in this market include the loan associations, commercial banks, and credit unions. And the lending is done through a mortgage broker who helps the borrowers to apply mortgage application and finish the process. Secondary mortgage market is where the existing home loans are resold to large banks like government-sponsored enterprise like Fannie Mae, Freddie Mac, and Ginnie Mae. Or they could also be sold to the investment banks. We call it private label securitization. A mortgage-backed securities is a type of asset-backed security which is secured by the mortgage or the collection of mortgages. So all those mortgages are sold to a group of individuals or government agencies or investment banks, which securitize or packages this mortgage together into a security so that investors in general public could purchase. And the structure of mortgage-backed securities may be known as pass-through structure, which means the interest and principal payments that borrower pays to the bank will be passed through to the mortgage-backed securities. Sometimes it could be more complex because it's made up of a pool of other mortgage-backed securities. How does mortgage-backed securities? If we look at the picture here, the home borrowers, they borrow money from the bank through a mortgage loan, and they have to pay back the bank's mortgage payment every month. And those banks then pull all the mortgages together and issued mortgage-backed securities and sell it to investors. So investors will spend money to purchase these mortgage-backed securities, so bank will receive the purchase price from these investors. But as a payback, banks need to pay payment to these mortgage-backed securities investors. How does it work? So if banks were able to receive mortgage payments from borrowers, they will pass this payment to the investors. However, if there is a lot of default in the housing market, borrowers were not able to pay back the bank the monthly payment. Banks will not be able to pay the payment to mortgage-backed securities, and those mortgage-backed securities will get into default. Residential mortgage-backed securities is usually secured by the single-family or multi-family real estate property, and commercial mortgage-backed securities is secured by commercial or multi-family properties like apartment buildings, retail or office properties, hotels, and other commercial sites. A commercial mortgage-backed securities is usually structured as different types of security than the residential mortgage-backed securities. So when the banks pull all the mortgage together and issued mortgage-backed securities, it's similar as stock. Those mortgage-backed securities also have different risk level. They were ranked from the AAA, the highest ranking, to the unrated. So what we can say is, depends on the risk level of the underlying mortgage loan, whether it's more safer loan from prime borrower or it's risk loan from subprime borrower. Those mortgage-backed securities can have different level of risk. For the AAA mortgage, it has the lowest level of risk, and for the unrated mortgage, it has the highest level of risk, because in case of mortgage default, the lower rated mortgage-backed securities will be the one who suffer the first loss. And because AAA mortgage-backed securities are backed by very safe mortgages, so they will be the one who suffer the loss at last. And also because those mortgage, they have relatively low risk, so they will have lower expected yield because it's lower risk and lower return. Depending on the amount of this loan, we can separate the loan into conforming loan and non-conforming loan. So conforming loan are loans meet the requirement for purchase by large banks like Fannie Mae and Freddie Mac. They set a dollar limit on the size of the loan. Those loans are usually have standard note, have the mortgage terms and appraisal report. They go through the standard mortgage underwriting procedure and meet the requirement for loan-to-value ratio and debt-to-income ratio by Fannie Mae and Freddie Mac. In the United States, most of the cities, the size should not exceed $510,000 and $400,000. But in a lot of places with very expensive house price like New York and California, the limit can go up to $765,000 and $600. Because conforming loans are more liquid, so they have interest rate advantage, so they will be cheaper for 0.25%. And for non-conforming mortgage, are those mortgage which do not meet the government-sponsored enterprise requirement for purchase. And those loans are called jumbo loans, and they will exceed the dollar limit for the conforming mortgage. Usually, they will have a higher percentage rate because of the high risk, but after that, for a period, the two loans have similar interest rate. Private mortgage insurance will protect lender against borrower's default, so it's required by the lender. Home borrowers will pay this insurance. We have to keep in mind this private mortgage insurance do not protect other risks like legal threat or physical hazard, and it's generally required for loans above 80% of the value of the property, so which means loan-to-value ratio above 80%. And it could protect lenders for loss up to 20% of the loan. Now let's look at an example. For example, a private mortgage insurance asks for 2.5% of loan in a single upfront premium and 0.5% annual premium, which is 0.041 every month premium. Assuming a house is sold at $200,000, the loan amount is 95%. Then what we know is the upfront premium for this insurance will be $190,000, which is the loan amount, 95% of $200, times 2.5%, which is $4,750. And the monthly premium will equals to the loan amount, $190,000, times 0.0417%, which is $79, which means the borrowers have to pay $4,750 upfront for this insurance and continuously to pay about $79 every month. Let's say this private mortgage insurance will insure up to top 20% of the loan amount, which means 20% of $190,000, which equals to $38,000. So how does this private mortgage insurance work? For example, assuming the borrower pays down the loan to $188,000 and gets into default. The property is sold at foreclosure sale at $180,000, which means the borrower owns the land $188,000, but they could only pay back $180,000. So the lender's loss in this case will be $8,000. Because $8,000 is below the $38,000 coverage, so the private mortgage insurance company will fully cover the $8,000 to the lender, so they will give lender $8,000 in this case. However, if the foreclosure sale price is really low and lead the lender's loss to be above $38,000, then the maximum dollar amount the insurance company will provide to the lender will be $38,000. The remaining part will be lost to the lender. Termination for private mortgage insurance could be allowed if outstanding balance fell below 80% of the current value, and the borrower is in good standing for the payment. And it must allow termination if the outstanding balance falls 80% of the original value. And there is an obligation to terminate if the outstanding balance falls to 78% of the original value, which means as home borrower, you should keep an eye on the outstanding balance of your property. If the loan-to-value ratio is below 80%, you'll be able to stop the payment for the private mortgage insurance. So now let's introduce other mortgage types. The first we call purchase money mortgage. So purchase money mortgage is issued to the borrower by the seller of the property as a part of the purchase transaction. It usually happens because the buyer cannot qualify for mortgage through the traditional lending channels, such as big banks. So the seller will give the borrower this option to get a secondary mortgage. And home equity loan means the borrower can use increased equity in the home as collateral to borrow more money besides the original loan amount. So in case the property value increase, the borrower will be able to extract more cash from the bank. Using the same property as collateral, it's often used to finance major expenses like home repairs, medical bills, or the college education. Reverse mortgage most happens for the senior household because a lot of senior household, their income constrained after they retired. However, as they pay down the loan amount of their property for a very long time, they own more than 80% of the equity in their property. And most of the seniors have very little or no mortgage debt, and they do not want to sell their home. So what they can do is they can get a reverse mortgage loan to convert the home equity to income without moving out of their property. So in this case, they can have extra income every year to spend. And the reverse mortgage loan does not require any down payment. It usually is a regular annuity disbursement. So the lender will give the borrower annuity amount at the beginning of each year. So it's either for the borrower for the budgeting purpose. It usually happens as lump sum disbursement, and there is credit line associated with it. So if we think about a traditional mortgage, what a borrower is doing is trying to pay off the outstanding balance over time and reduce the loan balance and increase their equity amount in the property. So what we can see is the blue water part is just the equity portion of the property, and the white part is the outstanding balance. So as time goes by, the borrower will have more equity in the house and reduce the outstanding balance. Reverse mortgage have the opposite effect. So for reverse mortgage, the home borrower will get money from the bank every year. So what they are doing is they are like use home equity as ATM machine and extract cash from the home over time. So as time goes by, their stand in the equity part in the home will reduce and their outstanding balance will grow over time. Let's look at an example for reverse mortgage. Suppose John has a house worth at $100,000 and he borrowed a reverse mortgage loan of $70,000 at 9% annual interest rate for 10 years term. How much John will receive from the bank every year, and what is the outstanding balance at the end of the first year? As we said earlier, reverse mortgage borrower receives annuity from the bank at the beginning of every year. So this annuity and accrued interest charge will accumulate over time to become outstanding balance at the end of each year. When the borrower pays back the loan, the bank will sell the property and clear the outstanding. So we will use financial calculator to calculate the annuity the bank will give to the borrower at the beginning of every year. So we have to pay attention in this case. To calculate reverse mortgage, we need to change the time of cash flow from your calculator to the beginning of each period. So the interest rate is 9%, number period is 10 years. There is no down payment, so present value equal to 0. At the end of maturity, the borrower has the obligation to repay $90,000 to the bank, so the future value will be $70,000 cash outflow. We can compute the period payment, so the answer will be $4,226.98. So we have to note, when the reverse mortgage is issued, borrower does not get loan from the bank. That's why present value equals to 0. At the end of the maturity, the accumulated balance is $70,000, which is the loan amount the borrower have to pay off at the end of the maturity. So future value will be negative $70,000. So this annuity amount will be how much borrower received from the bank. That is the period payment to be solved. How to calculate the balance at the first year? Remember, at the beginning of the year, the borrower will receive $4,226.98 from reverse mortgage. So the payment each year is the same amount. The interest cost for the first year will equal to the beginning balance times annual interest rate 9%, which is $380.43. The ending balance will equal to beginning balance plus interest cost for that year, so which equals to $4,607.41. So that is how we calculate the period payment and first year ending balance for reverse mortgage. There are other recent mortgage forms like interest-only mortgage. We talked about it before. So interest-only mortgage, which means you pay interest-only part for your monthly payment. So first we have interest-only mortgage with balloon payment, which means every period, your period payment just equal to the interest cost, and your outstanding balance always equal to the loan amount. So at the end of maturity, you have to pay back this loan amount. We also have interest-only amortizing loan, which means you have interest-only loan for up to a few years, and then you can convert to a fully amortizing payment for the remainder term of this loan. Hybrid ARM. For hybrid ARM, we'll have interest rate fixed for some years and then become adjustable. So the payment is always calculated as fully amortizing, which means the future value equal to 0 at the end of the maturity. And the fixed rate period can range from 3 to 10 years. Fixed rate interest rate will be higher if the fixed term is longer. And This hybrid adjustable rate mortgage successfully blends the need for borrowers for predictable payment with the need of the lenders for the market-level interest rate. Option adjustable rate mortgage, typically in this case, the borrower can select among three types of different payment: fully amortizing, interest only, and minimum payment mortgage. The minimum payment is usually based on very low interest rate like 1.5%. And this minimum payment increases 7.5% every year. Interest rate charged is adjustable and often is deeply reduced for the first few months. Typically, with minimum payment, the loan balance can grow due to negative amortization because your monthly payment is not even enough to cover the interest cost. So the difference will be added on top of the original balance. At the end of 5 years or when the balance reaches 125% of the original loan, the payment is recast to fully amortize the loan over the remaining term.